Good evening, NITians. Please take the seats in the front, those of you who are standing in the back. Welcome to our panel discussion this evening. My name is Pradeep Chalicheemala, currently serving as the Vice President for NIT Warangal Americas Alumni Chapter. I'm also the founding team member for Pan-NIT Network, Global NIT Network. Now, I also work as a hardware ASIC design engineer for a big networking company, not the biggest one, but the other.
The second big one.
The second big one, yes. Now, let's move on to the more interesting introductions of this evening. The first person I have on my right, Rahm Shastry. For NITians, definitely he needs no introduction. Alumnus of NIT Surathkal. Currently, he is CEO of Polaris Design Systems. Before I go further into his introduction, today's topic of this discussion will be entrepreneurship. But you guys know we can probably let these two gentlemen talk for a week or 10 days and they won't stop if we just say it's entrepreneurship. We're going to focus our discussion for how we value a company. That will be the theme. What happens when you raise money? What happens if you don't have any money to begin with? All those topics we'll try to discuss by delving into the vast experience these two gentlemen have. In 1995, Ram had a very well-paying job. Wife at home, not working. 3 young children below 5 years old. And he thought somehow that was the time to quit his job and start a company. He saved up enough money for 9 months, right? And then he said, okay, I'm going to do this for 6 months. If I get more money, I'll continue. If not, I'll get back to my job. That was his idea. He didn't have to get back to his job. He has founded a series of companies. He wore CEO hat for many of them, including Thalas, Systems, Nacentric. And over his career, he raised more than $30 million for all his companies. So we do have a person who got tons of money from investors. We'll know in a short while what he did. Right? He's a seed investor. A couple of years ago, he introduced us to Taxi for Sure, a company in India, a nice investment opportunity for NITians. And as we speak now, several news reports are mentioning that there is a deal going on. Another company called Ola Cabs is acquiring Taxi for Sure for $200 million to $250 million. Together they want to fight Uber. It's based on some news reports. It's not probably official yet, but you could find it on Google.
That's what I've heard too.
Yeah, we won't bug you for more information. Thanks, Ram. We're looking forward to a nice session this evening.
Thank you.
Welcome to the panel. The second person also has been a great help for the Pan-NIT network for the last 4 years. He came to our event 4 years ago. I still remember that passionate talk. Most of the details I have still in my mind. Thanks. Mr. BV Jagadeesh is a managing partner for KAAJ Ventures. He's also adjunct professor at Leavy School of Business in Santa Clara University. Board member for several companies including Scalearc, Cloud Velocity, and he's also advisor at few companies including Nutanix. But guys, more famously, he co-founded Exodus, which went through a huge IPO, and at one point, according to Wikipedia, has $37 billion of market cap in 2000. He was also CEO of Netscalar, sold it to Citrix for $325 million. Apart from these phenomenal successes he had, he is also very active in fundraising activities, giving back to the community, be it his teaching job at SCU, or how he's helping all of us. He's a great mentor. BV Jagadeesh, welcome to this panel discussion.
Thank you.
Let's just get started with very interesting thing I found, Mr. Jagadeesh. Did you guys really name the term data center at Exodus? That's what Wikipedia says.
We named internet data centers.
Okay.
The data center concept itself existed because most of the enterprises, right, already had the data centers. So what we coined the name was the internet data center.
Okay. But probably data center came from that later on.
Yes.
Okay.
Yeah. But data center, in the old concept of the data center, if you recall, I mean, those of you who have seen these mainframe systems era, right, who have worked in that era, it used to be like you enter into this raised floor room, and then you have all these refrigerator kind of large computers, right? I don't know how many of you remember, how many of you have seen that. So you used to you must be in the 80s. So that's what the classic data center that existed in most corporations, large corporations. So we came and said, hey, we are not that kind of a data center. We are an internet data center, right? Which is basically run from commodity servers like Intel-based servers and networking and those kind of things. So that was the new phrase that we coined and associated ourselves with the modern or next generation of technologies.
Wow, phenomenal story though. Yeah, let's get into our discussion for today. Most of us who are right now probably doing a job, and all of us want to jump in and do something, do a startup. But the unanswered questions usually linger around how these companies are valued, and that's what we're trying to answer today. The first question is, why don't you gentlemen take an example, probably the first time you raised capital, the first ever time. What was the cost? How much equity you had to lose? And if you could share that experience, that would be nice. So we'll start with Ram.
Yeah. Typically what happens is when you're starting, depending on the amount of money you're raising, if let's say you're raising $500,000 or less, or even $1 million or less, you use a convertible note way to fund yourself, because it costs too much to go through the entire process of getting issued stock and spend a lot of money with your lawyers. You want to save that money, number one. So typically there is no valuation set. You say, okay, I'm going to raise $500,000 and I'm going to give you 6% interest. That's kind of the going rate. And I'll give you some discounts, or because you are early investor, when I convert you into Series A round, I'll give you some 20% discount on the price, and then your interest accumulates, and then you convert into Series A. And the whole idea here is that you want to postpone the valuation discussion, because initially you really don't have any valuation. Now that's a traditional way, but today, in today's method, if you look at some of these companies, mobile companies, it's all about, you got money, you got idea, what do you want, that kind of thing. So does that make sense?
Yeah, fair. Accepting a lot of things from the financing valuation perspective. A lot of things have changed pretty dramatically compared to when we did the companies to where it is today. I'll take you through some of the scenarios and examples of when we did to how things are happening right now. But fundamentally, the complexity for a first-time entrepreneur to raise the money still remains the same, right? It's not as easy when you're a first-time entrepreneur, unless you have the pedigree of coming from well-known universities, right? And with some very well-known problem that you have solved in the past, and you're sort of like sought out by the venture capitalists or the investors to put money in you, right? A lot of times, venture capitalists are actually chasing some of these well-known guys, right, in different companies who have solved very critical problems, and they go after these guys, pull them out, and start companies, right? So But if you look at us, when we raised the money back in 1996, we were already into business 2 years. And the first 2 years, there was nobody who was willing to give us the
You
funding.
had revenues then already?
So, yeah. So, what did we have to do, right? I mean, we had our own consulting kind of a company that was generating the revenues, that was feeding into the excellence part of the business. And we had reached a stage where we were almost like $3 million at run rate revenue. And that is when investors felt more comfortable investing in our company, right? So, if you're a first-time entrepreneur, if you know some high net worth individuals who sort of know you from the past, or venture capitalists that you have worked with, to whom you have sort of demonstrated through your previous company that they kind of trust you, right? Then there is a good possibility that you can actually raise the money from venture capitalists very easily, right? Otherwise, you can just go in circles, 3 months, 6 months, 12 months. It would be very, very, very frustrating. So the whole myth that I can just walk around Sand Hill Road and then I get all these term sheets from venture capitalists, I don't believe that. I mean, I know of so many people, right, who have done well in their past jobs who have not succeeded in raising the money. So when you are a first-time entrepreneur, it is hard to raise the money. But once you have a proven track record, it makes it so much more easier. But that does not mean a first-time entrepreneur doesn't get the funding. He or she will get the funding, but depends on the pedigree. I mean, like, you're some hotshot Stanford PhD,
Sure.
right, who solved some amazing problem, right? Boom, they will take it. I mean, if you guys know of this company called AVI Networks, which was actually founded from some of the top engineers from Cisco, venture capitalists chased these guys, right? Chased them and then gave them on a PowerPoint presentation almost like a $15 million pre-money valuation. And same thing with this other company called Numerify, which is a company that is founded by some of the top product managers and engineers from Oracle. It was founded about 2.5, 3 years ago. Same thing. Investors were chasing these guys, Lightspeed and all of these guys, and they wrote a $8 to $10 million just on a PowerPoint presentation. Why? Because the guys were well known,
Okay.
and the VCs knew their potential, and that is how these first round of investments happen. So on top of that, but there are some other aspects to funding, right? Now you have angel investments. There's a lot of angel investors, high net worth individuals, who sort of, as you rightly said, from whom you can raise $250,000, $500,000, $1 million, like that, as convertible notes, right? Which then gets converted into a Series A once you have a product, once you have some proven and demonstrable data points.
I think let's expand on the convertible note. That seems to be the most popular approach for the beginners, right? For the first seed round or the angel round. Now, when let's say it's just 5% interest rate, so on X money, 100K money, and 2 years from then, the company closes down. Are they still on the hook for the 100K at that rate? Do they go after everything that the company has, or how does it typically work? Or how about the personal assets of the founders? Any examples would actually add a lot to the discussion if you guys could share.
So generally what happens is that this is basically deemed as debt.
Okay.
So in United States, when a company shuts down, in terms of obligations, the number one obligation is to the employees.
Sure.
You got to make sure that you've paid all your salaries, all of that, right? And the number two obligation is to the debt holders. And number three obligation is to the equity holders,
Okay.
right? So if let's say, you don't have any money, and whatever agreement that you have had with your employees, right? You walk away either paying some money or not paying any money and all that stuff. And then comes the debt holders. So if you have some assets, intellectual property, anything else, assets that you have, that gets sold, which gets distributed to the debt holders. Other than that, unless you have given a personal guarantee on your house, like how I had given at the time when we took a $100,000 loan from a leasing company, and they would not give the loan unless we gave a personal guarantee. So I had actually given my house as a personal guarantee, and we couldn't make the payment. And bank actually wrote a letter to me saying that your company has not made the payment, the last 2 months, and if they default in the next month or so, then we will have to come after your house.
Wow.
Also remember, when you start a company, you are incorporating your company. Once you have incorporated, then you take the money. That's the better way. That way, the company shield is there.
Okay.
It doesn't go after a personal asset unless you write something that we are talking about, special things like this. Personal obligation loans.
Yeah. Guys, by the way, we do have a pretty small group, so make it as conversational as you can. Let's take some questions. Yeah, your name?
Oswald.
Hi, Oswald, yes.
So when you say personal guarantee is kind of protected or shielded by the corporation, does it matter if it is a S corporation or a C corporation at that point?
So let me repeat the question just for the video. If it's a corporation, does it matter if it's S corp or C corp when it refers to the amount of shield it's giving to your personal assets? Yeah.
No, I don't think so. I don't think so.
That's the reason they have LLCs, limited liability company. That's the best way to go, because that costs you less as opposed to a full-blown C corporation. And that's the whole idea of S corporation. Actually, it flows through to the individual. So the company and the individual are the same as far as the IRS is concerned.
So just extending on that, if it is a LLC, does it prevent you, or does it prohibit, limit your options as you go further into the funding rounds later on?
Yeah, LLC does have limits on number of investors you can have, like 35. I mean, you can always convert to C corporation when you want to.
Right.
Secondly, investors prefer like a Delaware corporation for investors. It's a better for investors. So if you do a local LLC and then you can do a Delaware later on, you can do anything you want.
Yeah, Jagadeesh, let's get into some different topics. Have you ever invested in a company with zero revenues? And what was the criteria of the valuation? If you could just quote an example, that would be interesting. You don't have to take names. You can say company X.
Yeah. Absolutely. Right now, actually, I'm involved with a security company, which, again, based on the team that I knew, I did invest with zero revenues. In fact, the product was a little beyond a PowerPoint presentation. So a bunch of us came together, including the founders themselves, who also have put some money. So we ended up raising some $2.5–3 million of first round, which eventually became a Series A, even though it was all like angel investors that invested. And for $3 million, the pre-money on this company was about $6 million or $7 million pre-money. So post-money was like $9 or $10 million.
And what was the basic math behind that 6 million? And what kind of research usually goes into that?
Yeah. So this is it's a security company, and interestingly, the valuation in startup companies, there is no formula.
Yeah.
It is literally, you pick a number. That's how it works, honestly. Honestly, there is no formula.
And
right?
also in many exits, there is no formula.
Yeah. Yeah. So exits, it depends on how you pitch your story, how you build, if it's an M&A. If it's an M&A, then how you build your story to see how your product would strategically add value. So then you build some models, right? I mean, that's what we did. Because if we had taken, for example, this is digressing a little bit,
Sure.
but at the time when we got the exit, we were run rate revenue of about $60 million. So if we had compared ourselves, right, on a revenue multiple with another publicly traded company, we should have got the valuation of about $200 to $225 million. In fact, that's how Citrix actually started with us. So we basically said, I don't even want to talk to you. I mean, I basically said, I'm not even going to take this deal to my board of directors. So let's not even waste our time, right? So then his next question was, okay, what's the expectation? So I gave my expectation, which was 325 or 350 or whatever. So the rationale behind that was that market is giving you 225, right? But the value that we provide you by you increasing your top line and the bottom line because of us, right? So that's where you did some modeling to figure out, if your buyer has this many number of customers, and in that many number of customers, certain percentage of your customers, their customers will become our customers, right? That the very reason why you're going to somebody big is because you want to leverage their customer base and the sales force, right? So if you do a little bit of this spreadsheet exercise, you can actually come up with some numbers. So you use that as your argument to get the maximum. That's how you have to show a strategic value. Otherwise, if you just do a simple revenue multiples, which is all you can do in the early stages because you have no profitability, right? There is no profitability. So you take the revenues and you just do the revenue multiples. So we ended up getting almost $60 million run rate, but our actual revenue for that year was $48 million. We ended up getting like $325 million, which is almost like 7.5 or 8x, as against the market, which was at 3.5x.
That was for Netscalar, right?
Yeah?
That was for Netscalar.
Yeah, this was Netscalar, yes.
So,
Yeah.
I've actually observed when a company goes for an exit, it's a multiple of the revenue. Why is it not the multiple of the net profit or the gross profit?
If you have the profit, it could be PE multiple. So you arrive at a valuation as you were saying, right? So you arrive at the valuation based on so many parameters and an assumption too, right? So one calculation is based on this profitability, which is the PE, right? Which is what you see in public markets, right? Then the question is, how are you growing quarter over quarter or year over year, right? So you cannot just apply the standard public market P in a young startup company, because if you are growing at 100% year over year, which is a significant increase, right? Or if you are not profitable, there are so many companies, like you take, for example, Nutanix, right, which is doing $300 million in revenue. They're not profitable. And intentionally they're not profitable. Or you look at FireEye, for example, right? FireEye is a public company. Even today, they are not a profitable company because they are trying to grab the market as much as they can before somebody else comes in. So intentionally, they are investing to, so you cannot do PE-based valuation. You have to only do revenue-based valuation.
Even Amazon is like that.
Even Amazon is like that, yeah. Sorry, you wanted to say something.
Yes.
So actually I have two questions, but I'll ask one by one. So my name is Nishant. The first question is that what is the right time to actually start involving somebody else? Let's say we have enough to support ourselves. When should we actually go to investors? Because as soon as we get some money, we lose part of the company, right? That's the first question. The second question is that, let's say I am borrowing $250,000 in convertible notes. can I go to a bank and get a loan for that amount? So there's no liability from me to actually give some company. Is there a difference between getting an angel investment versus getting a loan from the bank?
So the first question was, when he started with his own money, what's the right time to go out and get some more to probably grow the pie? And then I think the second question was the difference between going to a bank versus a third party with a convertible. No? Yeah, Ram.
Right. The first one I think you mentioned, right? I mean, the question is, if you're ready to expand, you need more people, right, on your product. If you feel that, okay, you are profitable in your little thing, but if I have 5 more people, I had 3 application engineers and 2, whatever customer support, then you can say, okay, that's going to increase my revenue by such and such a thing. For that, I need money. That is the way investors will look at. Okay, you're going to raise money, but there's a hockey stick. It takes a while for it to take off, but it'll take off. But if you don't do that, you lose that opportunity. The opportunity cost is very high. Because a lot of companies I know, they just remain very low because they don't go out and raise the money, and they cannot grow. They don't have enough to invest and to grow. And then if you don't invest and grow, you die. Either you grow or you have to just shut it down. That's it. That's one thing. On the bank loan, almost depending on what you're doing. If you have revenue stream, you have profitability. The banks will look at only if you have cash in the bank, they'll loan against the cash. If you have $500,000 in the bank, they'll give you a loan of $400K. Okay? If you don't have money in the bank, then nobody gives a care. Nobody will give you. And that's why he had to, mortgage his house to get the $200K, because that's the only way. The banks are extremely, extremely conservative. Banks don't invest in startups. Forget bank loans. There's also SBI loan. I have people who have gotten SBI loan. It is a nightmare. It's not going to fly. That's my personal opinion. Yeah.
Thank you.
Yeah. The bank loan that you talked about, right? Either it's against some assets, company assets, if you have patents, some intellectual property, or customers' revenue, account receivables, right? So it's against that, or it has to be your personal property or personal assets.
So we used to do AR financing, account receivable financing. We knew that we had customers like Intel. They look at the quality of your accounts. It's not going to be Tom, Dick, and Harry. Okay, if I have Intel as a customer, I know Intel have a $5 million deal. I'm getting $500,000 a quarter. Okay, they'll give me a loan of 70% of that $5 million.
Account receivables.
Account receivables.
Okay, got it.
Okay, so banks will not loan. I know there are people, Vishal, I don't think you got bank loan, did you? No. So he's all his personal loan. He's sitting nice.
Bank is almost like, the credit card experience, right?
Mm-hmm.
When you don't need the credit card, everybody wants to give you a credit card. It's the same way.
Yeah.
When you have money in the bank, every bank wants to give you a loan.
Mm-hmm.
It's a chicken and egg problem, right?
Yeah.
So let's not go to banks, I think. Just for the company.
Don't waste your time on banks. It's not going to work.
Unless you're buying a house.
Yeah.
That's it. See, house is very easy because there's an asset. They can take it away from you.
Yeah.
Tomorrow they can come and say, okay, I'm taking your house.
Exactly.
Yeah.
Thank you.
Yeah, I think we are nearing the closing part of this discussion. Ram, maybe why don't you take one particular company that you worked for or you founded. Take us through how the valuation changed, or maybe how your ownership changed when you raised several rounds of money. Maybe some rough example. You again don't have to take names.
Right. So, I've been thinking about the company that, we can start with the company I sold in 2010. It went all against all the normal formula. So I came in because the company was being rescued. Actually, the investors brought me in as to be the CEO. I was not the founder of that company. Initially, they had raised money about $2.5 million, including big names like Andy Bechtolsheim and people like that. And the product was delayed. So they've been working on it. 2 years later, the product was delayed. And so the valuation, by the time I came in, they had already 40% was given to the investors. So 60% was owned by the founders and
Common.
Common. Yeah, Common. And then I was the CEO. So we had. So typically, what happens at that level, a CEO coming in, depending on how you've been 5 to 10% is what your typical Silicon Valley. A vice president will probably get about 2 to 3 to 4%, depending on the level of thing. Just to give you an idea, I mean, when you want to give stock to people, you wonder what percent I have to give people. It depends on how much risk they are taking, right? And they have a, whereas, so that's what, as a founder, typically you start a company, typically you want to obviously in Series A, the founding team and the common will own the majority. By Series B, it kind of almost get to, equal between the investors and the employees and the founders. By Series C, you're now 70% is owned by the, just to give a rule of thumb, 70 to 75% is owned by investors and 25% owned by employees. But what I tell people is don't worry about the valuation. It doesn't matter. The only valuation that matters is the exit valuation, right? So this company that I was talking to you, we had no revenue. I came on board, there was zero revenue. But lots of interesting ideas, and NVIDIA was a beta site, and so on. And I was able to get NVIDIA to agree to give me a purchase order for $500,000, $450K or something. And within 30 days, I sold the company for $24 million. No revenue, okay? So it doesn't matter. I mean, we took, but the thing is, like he was talking about, Mr. Jagadeesh, the idea was we showed to the acquirer, look at the value what we can bring with our technology. If we integrate with yours, your $200 million franchise will go to $300 million. For them to plunk $24 million was nothing, because they already see that going up, right? So it's not the, I'm not saying don't worry about revenue. What I'm saying is the value proposition of your product is very important, okay? Revenue will come eventually, and finally exits will come. We are losing money left and right. Another example I can tell you is that we are losing $80 million a year, but we sold the company for $200 million. Okay, so it doesn't matter. But the value was more of the acquiring company said, oh, I know you're losing money because of growth they're talking about. We are growing tremendously. We're growing like crazy, 200-300% a year. That's what they're looking for. Growth rate becomes a key factor when there is no earnings, profitability, because then they see how the two companies can work together. So I always tell them, when I go for, I do a lot of seed investing. There's a lot of, think about, oh, what percent we have to give you. I said, don't worry about this right now. Just focus on it. If you really believe in it, I think finally everybody will make money.
On the same topic, doesn't the founding members need to worry about losing the controlling interest of the company at some point? They can get potentially kicked out, right? Or is that overblown?
It's a little bit overblown. Yes, there are things that happen in the valley. I know that people get kicked out, but it's more an exception than a rule. Investors don't want to kick out the founders because they have put money. I mean, if they kick out the people who have the idea, then your money is worthless. They'll try their best to keep you. I mean, if you become completely difficult to work with, yeah, something will happen.
So, where the investors will want you to, more than removing means throwing you out of the company, it's more like give you a new position or something, right? So typically where that happens is if you've started a company in an area that is not truly your domain expertise, right? So maybe because of the technological advantage you have, let's say you started a company. I'll give you a real life example of that. And then the investors come in, and you have the product, and you have done a couple of proof of concepts, but you have absolutely no connections into the market, right? That is when the investors will come and say, hey, let me get a CEO who understands this market. And then you stay in some position, right? Unless, some egos clash or whatever, then you may have to leave, or they will ask you to leave, right? So this is a company, I was not actually investor or I was not on the board or anything, but this is a personal friend of mine who started a company in the media business.
Okay.
And this guy is a hardcore engineer, product manager who worked at Sun Microsystems, all of that. And he just saw an opportunity, right? In fact, the company it's a pretty phenomenal concept. So as you're watching a sport event, for example, you're watching an NBA game or an NFL game, right? You like certain play that's happening real time, and you want to capture that and post it on the Facebook or wherever, right? So this guy basically designed and came up with this whole algorithm based on listening to the sound that is coming from the TV. So you just take your iPhone or an Android phone, open up that application, it listens to the voice or the sound that is coming from the TV, right? And it recognizes exactly what channel that is, and he'll give you a 2-minute of video capture on your screen. So now you can actually move around and you can say, hey, this is a great pass that the quarterback did that I want to post it immediately on Facebook. Pretty amazing. Technologically, it's an amazing thing. But this guy has no idea at all
From the business side.
on the market,
Sure.
right? So the company exists. It's called Livestream.
Oh, yeah.
The company is called Livestream.
Okay.
Right? You can actually download the application and you can do it. So the investors ended up getting a CEO who sort of understands the media business, selling into the New York or media kind of companies, right? Because that's where the partnership is needed.
Okay.
You got a partnership with ESPN or Sony, those are the kind of things that you want to partner with. So they needed a CEO who has got connections in that market. So that is when the change actually happens. Otherwise, investors, why would they throw you out? Why would they throw you out?
Does that mean it's important that you need to find investors who really understand your business? Let's say there is another investor who just trusts you but has no clue on what you're doing, but he's willing to put money just on what he thinks of you. Do you still go and work with him? Or is it risky because later on somebody might, let's say, bug him and there's no value in the business, why did you go that route?
Yeah, if you ask, this friend of mine who had to quit, I saw this guy basically doing his company in a garage, in his house, right? He had engineers, he was feeding these people, he built the company, he brought to a stage where the product actually works and, it has these initial customers and all that stuff. So obviously he's very upset. The fact that he's no longer with the company, right? But I think, my advice to him was that he should get this new CEO, and it's an opportunity for him to actually learn how to build the company to the next level, and that's something that he doesn't know. If you know this company, Aruba Networks.
Yeah.
Aruba was actually founded by two guys. The guy who is the CTO right now, which is Kirti, and then his partner was Pankaj Manglik, right? They both started the company. And at some point of time, and Pankaj's background is basically product management. Both were product managers.
Okay.
Both Kirti and Pankaj, they both are actually product managers. But at some point of time, when the product was done, these guys were not able to take the product to the market. So this Sequoia basically felt, hey, let's bring a sales-centric CEO into the company. Okay. So then they brought, someone from Cisco, made him as a CEO of the company. And he could have actually continued as a VP of business development or something. Instead, he chose to leave.
Okay.
He chose to leave Aruba. So that's why, you will not see Pankaj's name associated with Aruba, right? Mostly it's Kirti, whose name is associated with Aruba. Personally, if I were him, I would have basically continued.
Okay.
right, in that VP BD role and learned the business and associated myself, with this success under my belt that took the company all the way from 2 people into a successful IPO with thousands and thousands of customers and almost like $1 billion in revenue. That's a huge achievement.
One thing I want to advise people who want to start a company, I know this is your baby, this is your idea, and you want to do it. But also remember, every one of us have limitations, right?
You should know.
You have to recognize that. If you recognize that, your investors will also see value you bring to the table. And I don't think there will be any clash that way. Typically what happens is when you don't, you feel like I can do everything or I can do better than that. Because a CEO for a $5 million company may be a misfit for at $50 or $500 million. Because you're a completely different kind of customer base, business models, everything change. And at the end of the day, keep in mind, you have your shares. Let the other guy make you rich. Okay, you do your work and let the other guy, he has the right thing.
And you learn.
You learn.
During the process.
And hopefully, maybe the next company you have that and then they'll be fine.
Correct.
And I've seen this happen over and over again, a lot of clashes. We understand when you start a company, you have big egos. I got a better idea, better mousetrap than everybody. I know we all do. We all feel like it. But at the same time also, what I tell people is just to keep yourself open that your job description may change a little bit. It doesn't matter. But most important is you have your equity position. Why do you quit and lose everything or lose partially and so on? So that's my advice to you guys. I think I always tell my kids, be humble. And that's one of the humble, I always tell them, sometimes they look at me and say, what are you talking about? Just startup, you can do everything. Yes, you can, but sometimes you cannot.
Great advice, Ram. Let's close it with one final question. I would leave it to you gentlemen to pick who would like to answer. But when do you think, or when, let's say a person wants to start a company, are there specific criteria to figure out that he or she is ready to quit whatever she is doing or he is doing right now and jump in? What's the homework? Maybe if you could take a minute and then.
I think there is no one such thing.
Yeah.
But it all comes down to you individually, right? I mean, when I decided to jump, in fact, the story is very similar, right? Because my second kid was born after I started my first company, right? So I had a 5-year-old kid, and exactly the same way, I wanted to try this out because this was my dream to start my own company. So I just wanted to try this out for 1 year or 1.5 years. So I planned financially that if it doesn't work out, just go back and take up a job, right? So ultimately it comes down to your own passion and believing in yourself, that you want to do this. So there are a lot of people who remain on the fence. Hey, I want to do something, I want to start something, but they never take the risk, right? Plan it, take the risk, try it out, because until you try it out, you really don't know. You really don't know what it is.
One more thing I have also seen, I'm sure you may have seen it too, is that you have one foot in your regular job.
Yeah,
and
that will never work.
Yes, that will never work.
That will never work.
And one thing that was very clear, when I first started a company, I talked to a lot of people, and they said, you know what, unless you quit your job, and we had an office on Alameda in San Jose, really shitty looking office, it didn't matter. And we quit because I said I had 9 months of cash, 3 of us started. And 3 months later we got funding, and the matrix partners came in and put money. And the reason was that he said was because I know you believe in your idea because you quit your job, you have 3 kids and you have a family, and you quit your job and you are not taking any salary. And when you have one step in the regular job, a cushy job, $250K pays you in the office, and you got nice health benefits, and then after work I'll come and work on something, very difficult. And I'm not saying it's impossible, but especially if you have a family, you don't have enough time, and you're shortchanging yourself. If you really believe it, jump.
So you do have to test the depth with both feet, right?
That's right.
We'll have to close now in the interest of time. Ram and Jagadeesh, wonderful, and keep inspiring, keep lighting those fires.
On this valuation, this class that I teach, it's actually one of the classes that I teach. So if you are interested, I can actually send the shares, the slides that I have.
That would be helpful.
Right? Because that takes you through seed investment, Series A, Series B, Series C, exit, what the valuations look like in each of these rounds, and convertible note, how that works. I have all those things actually.
We'll probably post it along this with this session.
I'll send that. I'll send those slides to you.
Thank you.
You can just post it to.
Thank you very much.
Thanks again, guys.